Hello and welcome to this update on Amati's AIM IHT portfolio service for the year from January to the end of April is the period we're going to cover. So about 4 months. This has been a very eventful period for AIM, largely resulting from the changes to the inheritance tax rules, which the Chancellor brought in about 18 months before, well, 15 months before in November 2024 in the first budget when she changed the rules for inheritance tax. And one of the consequences of that was that AIM, while it retains its IHT status, only qualifies for 50% relief. And that change was brought in April. So if you like, what characterized the first 3 months of this year for quite a number of AIM companies was really the final period of adjustment to the new rules. And I'd say that the rule changes have been very disruptive to AIM. They've been, I think, pretty counterproductive policy. I don't think they'll really save the Chancellor any money because there are various anomalies in the way the rules work, and perhaps the most glaring is that the tax relief didn't change for other kinds of IHT schemes. So there's a lot of debate. Suffice to say, there's a lot of debate going on about where these rules should settle, and I'm not entirely sure we've seen the final picture. But what we can be reasonably sure about is that AIM is, as an IHT source of IHT relief, is here to stay, and it remains the only way one can mitigate IHT from within an ISA. And I think that's probably the place which IHT management has come to settle on using AIM portfolio services. So it has a valid role. But the disruption to the market was quite widespread, and part of it was a fear that the relief was going to be withdrawn altogether. And we've certainly not had any indication that that's been mooted or being discussed. You know, it's much more, there's quite a lot of pressure on government to unwind some of what they've done. But that fear of further IHT disruption, which hasn't happened, but the fear of it has driven quite a number of companies to seek to move from AIM to the full list, and that has been disruptive to AIM investments. And the number of companies were advised to do this. Gregor and I have discussed this a lot. We think it was very ill-advised, and we can't think of any example where a company has moved from AIM to the full list and has any tangible benefits to show for it. Mostly the share prices end up lower than they were beforehand. And if you like, what the trade companies are kind of doing is they're swapping very long-term active AIM IHT portfolio type managers for index trackers. And the gambit is that if you're big enough, you can get to the mid 250 and you can attract passive money. But that money has very different characteristics, and it doesn't necessarily have to buy you on day one. Anyway, for whatever reason, and I think we would maintain that actually these two markets, the mid 250, the FTSE small cap, and AIM, are entirely fungible from many points of view. There's no really significant differences in the level of corporate governance between the two, no difference in the level of consumer protections between the two. And most investors treat the two as being fungible between them. So if money comes out of one, it will also drain money out of the other. If valuations go down in one, then money flows across and valuations fall across the board. So there's been no way to mitigate the basic problem, which is the money flowing out of the UK stock market, and that's been happening for I can't remember how many years, 4 or 5 years. Money's been just dribbling away, being attracted primarily by the incredibly strong pull of the US. So I think the summary from my point of view is that this whole long move peaked in March. This long move towards pressure on the market peaked in March. And really, I think since then, it feels like the dynamic is shifting a bit. And those people who wanted to make adjustments to their AIM portfolios have really, by and large, done that. And we noticed that in January, February, March, lots of companies fairly randomly across AIM were being sold off as people were making these adjustments. And then in April, suddenly it became quite hard to buy these companies. And it feels like liquidity has begun to tighten in the market, and the people who are still invested very much want to own the shares. It feels like outflows from AIM services have been, very much dropping, and the market's tightened up. And hopefully we'll see more of this through the year. But that particular episode of the rule changes followed by 15 months of progressive adjustments, that seems to have completed. Before we got there, just to kind of talk about the shape of the year, after a strong January, which was most of us in UK small cap were beginning to think, it really is time for the tide to turn in this market. It's so lowly valued. It's so much of the value creation in these companies is going unrecognized. But then we had a massive gold and silver bull run in January, which peaked right at the end of January, and there was a very sudden sharp sell-off one Friday. That hasn't particularly impacted the AIM service, because the way our criteria work is we don't often invest in natural resource companies just because they very rarely fit the criteria that we're looking for. And that's a point Gregor will talk more about later. And then in February, the thing that really, two things caused problems. One was so-called SaaS-mageddon, and SaaS stands for software as a service. It's a business that many of the most successful companies on AIM have done incredibly well at. These are software companies, they're capital light, they have recurring revenues, they have niche specialties. The good instances of SaaS companies on AIM are very strong businesses and have been for many, many years. But in February, globally, and this really started in the States, there was a bit of panic around. It was like collectively investors decided that AI was going to cause a problem to SaaS companies, and that led to software companies going down. The few hardware companies around, and there's not many of them on AIM, companies with hardware for data storage or hardware for space communications or hardware for memory or chips. These are few and far between on AIM, and they did very well. Most of them didn't really meet the criteria that we have for this portfolio. But the SaaS companies sold off, and we think actually this was largely an overreaction. I mean, clearly there's a lot to think about with AI and software, but in the first instance, software is a great tool for AI is a great tool for programmers, makes programmers more efficient. And the kinds of companies we're investing in, which often have proprietary data, they have strong niches, huge amount of domain expertise, they will benefit from the efficiencies that AI brings. It's highly unlikely that the customers of these companies are going to be able to just take some AI and replicate the software that's being sold, on so-called vibe coding. I think that's very far-fetched to imagine that corporates are going to suddenly do that. Corporates have always had the choice as to whether to develop internally or buy in software, and the pendulum may swing a little bit more towards internal development. But for the core platforms that the companies use, it's highly unlikely that suddenly disappears. And then in March, right at the end of February, we had the invasion of Iran, and in March there was a very nervous, fractious, ugly mood in the market. It coincided with the last month of these AIM rule changes, and the oil price shot up. Political uncertainty crept in. Inflation's been picking up. Bond rates have been picking up, and the war in Iran and the disruption in Iran, and then obviously the long prolonged truce talks, peace talks, which have really not so far yielded anything other than no more actual fighting. But the nervousness remains, and the Strait of Hormuz, which is acting as this pressure point on the global economy, remains shut. So pretty tricky period. And I'd say that actually the fact that there's been relative calm with some ups and downs in the market, but actually quite a lot of resilience in the market. We should take quite a lot of courage from that, and it's suggesting actually this market is more resilient than one might think here, and in part that's because it's become a very heavily oversold market, and that always helps when there's disruption around. Most of the people who wanted to sell have sold, and Gregor and I both think it's not going to be long before the value of the market attracts significant new buying, and we'll have better days ahead. So that's the kind of broad shape of the 4 months we've been through, and I should just put up this slide here, which just shows the number of companies that we've seen moving from AIM to the main market, and a lot of these were ones that affected the portfolio. These are all companies that we held in the portfolio, and we've had to, over the past 12 months, really make a lot of adjustments to. These companies have to be sold. We have to choose the timing of the sale, and then we've got to find new names to replace them. And we think we're through this period of churn, if you like, and of companies deciding to move, causing that disruption, new names coming in. And so with that, Gregor, why don't you talk us through the main performance aspects of the first few months?
Sure. Well, to the end of April, the fund was up 2%, and the benchmark, which is the Deutsche Numis Alternative Markets Index, was 5.4% ahead. And that's mainly down to the absence of natural resources companies within the fund. Oil and gas companies have really leapt since the start of hostilities in the Middle East. And most of these companies don't typically meet our criteria for the fund. Either they're loss-making or they're too volatile for the IHT service. But we do look for substitutes, and this top contributor over the period came in the form of MP Evans, which is a sustainable palm oil producer. And MP Evans has really started to benefit from the higher prices for its product. It uses those profits to expand the acreage, and it uses that expanded acreage to drive the profits. So there's something of a sort of virtuous cycle at the moment, and the market is really starting to pay attention to what they have they've built. The second one thing that gives us confidence that the current discount that UK small caps trade on is the ongoing takeover activity that comes from international peers or larger UK companies, and in particular from private equity. And Kitwave, which is a wholesaler, food wholesaler, was one of the 18 companies that has so far been acquired from the London Stock Exchange. It was bought by a private equity firm on a 33% premium to the share price. So that one exits the market, but it has made a good contribution in the fund. The next one is Cohort. Now, Cohort's a UK, European, and Australian defence and security firm. It comes as no surprise that all these three geographies are having to refocus on the role that defence needs to play. We're at the start of a sort of major investment cycle, and Cohort is really well placed to benefit in all three markets, and the market has started to react to that. And the final one I'll mention on the positive side is Volex. They make cables and components. Two of their markets are data centers and EV, electric vehicles. Both have been growing extremely quickly over the last year or so. And again, that one's enjoyed a real re-rating. On the detractors side, I think most of these were affected by macro rather than company-specific factors. Gately, I'm afraid, has had a couple of downgrades, but also professional services. It's a legal firm. AI and how that's going to reshape how we engage with professional services, has seen some weakness in that share price. Jet2, obviously people are booking fewer holidays since the start of the conflict, and jet fuel prices have obviously shot up. So Jet2 are sort of suffering both in terms of being able to supply the service and demand for the service. Boku is a victim of, as Paul mentioned, the SaaSmageddon, this idea that going forward, software companies won't play the same role. We think for things like Boku, that's pretty fanciful, but it has affected the shares over this year to date. And the final one I'll mention is Springfield Property. It's a house builder, and house builders have really reacted negatively since UK interest rates started to look like they were going to trend upwards, rather than make it easier for mortgage rates over the course of the year. But Springfield, has some pretty unique selling points. It's in a part of the UK where there's a lot of infrastructure investment going in, and that rather separates it from the rest of its peers in the sector. A silver lining of the kind of low valuations is that we have been able to recycle a lot of the capital that moved from AIM to main into companies that we've been monitoring, in some cases for a number of years. And here you can see some of the examples: U Group and Hargreaves Services, Fintel and Tatton, companies from different sectors, but all companies that really have been trading at the lower end of their valuation range, and are all high quality, profitable, dividend paying, and good additions, we think, to the list for the rest of the year. So that brings us up to about 32 holdings in the fund. The median market cap is 270 million. The average there is 355 million. And that's because we don't really need to go down the market cap spectrum too far to find good quality candidates for the fund. The way that we think about the fund is into sort of three baskets: management and family, established tech, or durable defensive. And we're really screening the companies to make sure they fit into one of those three baskets, to make them appropriate candidates for the fund. And you can see on the sector breakdown, that means we're slightly ahead in industrials and ahead in financials. And as I've mentioned, we don't typically invest in mining, which is basic materials, and oil and gas, and that's why they are underway within the fund. So here's just confirmation of the market caps. I'd say that the lower end of 50 to 100 million, that's really two companies. The market cap's about 90 million. That's about as low in terms of size as we have to go. First of all, because we don't have to, and second of all, because liquidity starts to get more challenging once you go below that level. In terms of the value of the fund in aggregate, it's on about 11.5 times. So there's a tremendous value compared to the historic rating, or the rating of other small cap markets, or even now the rating of the the larger UK names in the UK. Style Analytics is a firm that helps us also analyze where these companies, which bucket or basket these companies fit in. So it won't come as a surprise that most of them offer higher than average growth, higher than average quality. They tend to be lower on the volatility, and they tend to offer more value than average. So that gives you an idea of how we screen the companies and the candidates before they go on to the fund. And I'll hand back to Paul to go through some of the top 10.
Thank you, Gregor. Yeah, it's actually pretty unusual in that Style Analytics that you can have both value and growth and quality all at the same time. But it says a lot about the market. That normally value would be lower down on the priority list, but right now it feels like you can have everything in this market. Top 10 holdings. We'll just put this up just to talk about, obviously we think these are a very strong group of companies, but just wanted to give you a flavour of just exactly how different they are and the range of activities they do. MP Evans, Gregor's mentioned, that's palm oil grown in Indonesia. Renew is engineering services. It's all about maintaining the UK infrastructure. It is not discretionary spend. Sometimes it gets a bit delayed, but it always has to be done. Property Franchise Group is one of the most successful lettings agency franchise businesses in the UK, trades under a number of different brands. It's been a huge success story over many years. And U Group, Gregor mentioned briefly, this is a company that we've recently invested in. It's a supplier of gas and electricity to UK businesses. So importantly, not consumers. The dynamic in the business market is very different. And competing in this market, you've got to have a very good supplier. U Group have a back-to-back deal with Shell. So Shell is, if you like, structuring all the long-term supply of energy to them and fixing the prices. They're able to offer contracts up to 10 years fixed price with the Shell arrangement. And the key to really understanding U Group actually is that the software platform they've invested in to enable them to quote more efficiently, more accurately, and faster than the competitors to companies that, let's say you're a UK business, you want to change your supplier, you've got 50 different meters. U Group will give you a quote within a couple of hours, and they'll know if they want you as a customer or not very quickly. That's quite a complicated set of calculations to do, and they've been just gaining market share significantly on the back of this efficiency. Cohort, Gregor mentioned, one of really significant UK defence company. Restore, this is all about document management and storage. The core of it is just storing cardboard boxes, which companies have to do. So their customers, typically like lawyers, for example, having to store boxes of information, boxes of papers for very long periods. And then Restore built up a business really around that into all kinds of ancillary areas, whether it's digitization, IT disposal, all manner of adjacent markets they've been filling. And the last update, all parts of their business seem to be doing well. So and the reason for mentioning these is just to show this is not just it's not straightforward. Interest rates go up, all our businesses suffer. This is a very well diversified portfolio designed to be resilient in difficult circumstances. Boku, just so it's been mentioned already as well, but this is an international payments business. Its customers include all of the top vendors of digital material worldwide. So I'm thinking, this would be Microsoft, it would be Sony, it would be Apple, it would be Google, Spotify, Netflix. If you're buying digital content around the world and you're outside of those companies' home markets, you're probably going to be paying through Boku. And Hargreaves Services is again a fairly new name to the fund, to the portfolio. And yeah, I won't go through it all in detail. Unifar, Hargreaves Services does a lot of heavy moving support services for construction and infrastructure. There's a lot of investment going in the UK to those areas in the next few years. That's what's attracted us to that company. Unifar is it's the largest wholesaler of medicines to pharma stores, to pharmacies in Ireland, and it has a large European specialty medicine business as well. And Netcall, fantastic software company. So it gives you the flavour of how widely spread the portfolio is. And then just before we run out of time, I'll just whiz through a few graphs. And the idea of these is really just to show how much of a disconnect there is between the way the earnings of these companies have evolved over the last few years and their share prices, which just haven't kept pace. So we've just seen derating kind of across the board, really. And this is why we're optimistic about where this market should go in the next couple of years. There's plenty of scope for this to kind of mean revert and the ratings to reestablish themselves. So here's Boku, fantastic earnings growth over 5 years, consistent derating, shares well behind. Netcall's kept pace a bit better, but still hasn't really kept pace with the updates, the upgrades. MP Evans, this is unusual, because this is a contrary one here, that actually this is more than kept pace with the upgrades to the stock, but that's because there's upgrades baked into this company from the higher palm oil price resulting from the higher energy prices around the world. Cohort is this one. Defense is a hot sector. So this one has kept pace, but we think the defence industry has got a decade of very strong growth ahead of it, and so that's really why the market is recognising that. Brickability at the other end of the other extreme here. Over this period of time, 5 years, we've seen pretty good growth in earnings, but we've seen the share price halve. And so this is really extreme for the scope for re-rating in this company. It's a cyclical business, but any kind of cyclical upswing should result in a very significant return. Paterson had fantastic earnings growth over these 5-year periods. Over the last few years, I think that the share price just hasn't kept up. So shares have been derating while the growth continues. So at some point, this is going to go the other way. And then Restore, the business I talked about earlier, because he has had good earnings growth. Is just looking at a couple of years here, and the shares have just really lagged all of that growth. So again, it feels like there's good pent-up energy. Franchise brands run by, this is a franchise business run by the ex-Domino's pizza team from the UK, but they've gone into B2B businesses. Lots of earnings growth over this 5-year period, stalled a little bit over the last 3 years, but the shares are now lagging a long way behind the earnings growth, and we're beginning to see that earnings growth re-establish itself. So again, we think there's very good potential here. And then finally, U Group, one we talked about quite a lot already. Just looking at a couple of years here, because if I go back any further, you get the law of small numbers kicking in, and the earnings growth is very, very high, but that's because it started off quite small. But even these last 2 years, lots of earnings growth, nothing on the share price. Yeah, what comes next? And we're actually, from this bottom-up point of view, pretty optimistic about what these companies can do as soon as the market begins to find its feet again. And yeah, Gregor, do you just want to give us a quick conclusion and we'll wrap up?
Yeah, sure. So in summary, we're looking for companies that are higher quality and lower in volatility, and we do that by putting the candidates into 3 baskets: family or management ownership, established tech, or durable defensive businesses. As I say, the silver lining is that a lot of these businesses that come across the screen are on extremely attractive valuations, both against global peers and even larger cap UK companies. What's the evidence that that's real? Well, there's takeover activity in the UK market, every single week. And secondly, when companies do have excess profits, they're using that cash flow to buy back and retire their own equities to try and signal that they feel that the valuations are pretty beaten up. In terms of AIM, we've gone through the tax changes, we've gone through the AIM to main switches now, so things are much clearer now for the rest of the year, and hopefully we can make progress from here.
Thank you.
Thank you very much.